Hello, and welcome. Rafi Sosikian here for Pinnacle Quant, and in this video, I'm going to introduce to you a new tool that I'm releasing to the NinjaTrader ecosystem called VR Data Analyzer. The V stands for volatility, the R stands for range. Having the type of data that VR Data Analyzer will produce for you, a trader can essentially determine the type of volatility and the type of range one can expect during that day based on, particularly if they're trading index futures, based on the VIX. In this example, I'm going to be using the VIX futures, and I'm going to run the analysis for 6:30 to 7:30. That's the initial hour of trading, because we're going to use the initial hour of trading to make a prediction for the rest of the day. But the prediction isn't just based on that initial hour. We have to make it relational. That means we have to compare it to the previous day, and you might want to also compare it to that particular day going back in time. So if you're analyzing Friday, you check the other Fridays to see how it would have performed. And in this video, I'm going to provide you an actual hypothetical backtest based on the data and provide for you days that, based on the data, you want to potentially avoid trading, particularly avoid trading the more popular instruments that a lot of people trade, like the SPOOs or ES, NQ, YM, RTY, the index-based futures. So let's jump right in. So I've got VR Data Analyzer loaded, and essentially I'm doing some acrobatics here with the NinjaTrader, the code within NinjaTrader, NinjaScript. So what I've done is I'm going to go ahead and run this for the VX futures. I'm running it between 6:30 and 7:30. That's the initial hour of trading. And I am in Los Angeles. This is Pacific Standard Time. If you were running this, obviously, if you're in the East Coast, you would change this by hitting the up button to 9:30, and this would be 10:30 for you. Okay. So this is for the VIX. I'm going to run it for the whole year. Essentially, you can run it for as much data as you have. It needs to be on the 1 minute bar. So when I run this, in fact, let me make sure that this is a unique name. You want this name here to be unique, because I'm going to write the system is going to write a CSV file to your documents folder, okay, on your machine. So let's make this unique. Let's add a 1 at the end of it. So because I had run it with this file name before for the VIX futures. So I'm going to go ahead and run it to make that unique. In fact, let me include 29. Today is the 29th, but it is Saturday, so there's no data. So it's going to stop on the 28th. So let's go and run it. That's it. It just ran the data. So in essence, on the chart, it'll print it'll plot three things. It's going to plot the open price, it's going to plot the high price, and it's going to plot the low price for that initial hour. Okay, so we ran it between 6:30 and 7:30. It is essentially finding the high, the low, and the open for the initial hours. So it is denoted in the colors that you see here: open, high, and low. So let's take a look at what it's done. So in the documents folder, I'm going to go there. Let me X out of this. And it's going to load the file, the CSV file. Okay. So once I load it here, it's going to open up automatically to my Microsoft Excel. I particularly don't like doing an analysis on Excel. I prefer Google Sheets. That's just my way of doing it. So what I'm going to do is copy this, and I'm going to paste it into, let's open up a new sheet here so it's nice and clear. I'm going to paste it into my Google Sheets. And since I want this to be a nice spreadsheet that I can quickly analyze, I'm going to click on data. I'm going to split the text to columns. I don't want it to detect automatically for the separator. I want to choose semicolon, because I've done it with semicolons. So there it is. It's loaded all the information that I'm looking for here. So let's get closer to where we are. Currently it is, as I mentioned, I ran it for 10:29, but 10:29 is a Saturday, so there's no data there. So essentially it's got this data. All right. So by looking at this very quickly, we can determine that this C, D, and E is the open, the high, and the low, and F is the difference. So what is the difference? It is the difference between, or the diff between, the high and the low, okay? And that is the type of range that it had for each one of these days, okay? So let's just choose Friday, all right? On Fridays, okay, we've got Friday here at 0.55, and we've got the other Friday here is 0.7, and the other Friday here is 1.8, and so on and so forth. Okay, let's go up a little bit more. We have Friday 0.95, the next Friday is 0.9. I think that's enough data. So we have 5 examples of Fridays here. Okay, so that's one way we can compare it. The other way we can compare it is as to what happened the day before. Okay, so that was the range the day before. So we're focusing on Fridays right now. Now let's go ahead and take advantage of this data and apply it into Price Action Harvester Automated. So let's go ahead and show you that. So I've loaded Price Action Harvester Automated version 5. I'm going to look at Fridays because I want to look at the last 5 Fridays, in particular the ranges that VR Data Analyzer produced for Fridays. I want to see if the ranges are making a difference here. Okay, so we're going to do an all things being equal test. So we're going to run it for special operations, which is the most aggressive part of Price Action Harvester Automated. We're going to go both directions, long and short. And we're not going to use any of the defensive mechanisms as far as modulate break-even and move stop goes. For money management, we're going to say if we hit $5,000 net during that session when the trades are flat, let's go and stop looking for further trades. Conversely, if we lose 20 or we're down $2,500 or more during that session, during when the trades are flat, go and stop looking for trades. 10 consecutive losing trades, stop looking for trades. So we're going to be aggressive here. That's these numbers represent that because we're essentially just looking for one contract that we're trading. And so special operations is aggressive. You're supposed to use it when you have an event-driven reason to use it, whether it is economic news, it's geopolitical news, it is the VIX over 25, etc. Okay, so let's go ahead and I'm going to do a couple of different tests here. This test is going to say the risk to reward is 1 to 10. Okay, that's my ratio. For every tick of risk that I'm taking, I am looking for I'm hopeful for a 10 ticks of profit. So it's a 1 to 10 ratio. It's going to flatten me out at 12.59. Let's make sure we have slippage. That's 0. Let's put in usually 1 for, I'm going to test the SPOOs or the ES, which is the most popular one's index. But usually it's 1 tick for the SPOOs because the variance between the ask and the bid is usually or typically 1 tick. It's not always because nothing is absolute in trading, but I'm going to go and put 2 ticks anyway. So let's go and run this between 9:30 to 2022 just so that we can zero in on the dates that I showed you here. So 9:30 Friday, I'm just going to be focusing on Fridays, and then we're just going to do every Friday since then. Okay. And now you'll notice that the ranges between the high and the low, the diff, is not always the same, right? So on 9:30, in fact, it's generally not the same. So on 9:30, it was 0.9. Okay, on 9:14, for example, it's 1.8. Okay, that's a significant difference. And then you see on Friday, it's 0.55, and then on the 21st here was 0.7, and so on and so forth. So they are different. The ranges are different. Those are the ranges going to make a difference in our trading hypothetical results here, all things being equal. Let's see. Nice test, right? Let's go and see what the results are going to be. So let's make sure we have everything that we want. We want Friday. We're not doing anything here because we're not checking, so we're not using that strategy. We're using special operations strategy 2. We're not going to use we're not going to use accumulation breakout strategy. That's the third strategy. Incidentally, if anybody wants a demonstration of how Price Action Harvester Automated works, and we can discuss these 3 strategies as well as the defensive mechanisms like modulate break even, which is not the usual way that break even is used, and move stop, which is not a trailing stop, or any of the other parameters here, I'd be happy to share that. Just request a demo from pinnaclequant.com, and we can arrange a time and give you a demonstration of how this works. So I'm going to run it between 9:30 and 10:28 to capture all of the Fridays that we're after here. And we're going to do a all things being equal test. So 25 ticks of risk on the SPOOs for 250 ticks of potential profit. Let's go ahead and run it and see what we got. And we do have 2 ticks of slippage. Let's see what we've got here. All right, so those are the results. Let's break it down. Let's do daily. So 9:30, 10:07, 10:14, 10:21, 10:28. Okay, so all of these days actually made, this is obviously hypothetical results, but it made money. Okay, so let's go back to the data. Let's see what the data showed. So all of the days made money starting from 9:30. Okay. The only day that didn't, is this one, 10:14. Interesting. On days where the difference is about 1.4 or more, okay, I've noticed, this is my personal opinion and observation, that bulls and bears get slaughtered. Whatever direction you pick, it goes counter. Okay, obviously that's not an absolute statement, but typically that's what's happening when you have the difference between the high and the low over 1.4, and this was 1.8. Okay, so that's just a very quick example. Let's do a different ratio. Okay, so I did a 1 to 10 ratio. A lot of people don't trade this way, so more likely they'll do a 1 to 2 ratio. Okay, so 35 ticks of risk, 70 ticks of profit, 1 to 2. Let's go and run it there. So let me give you a summary of what it was when it was 25 and 250. Now I'm going to run it for 35 and 70. Okay, so I'm running it now. All right. So everything improved as far as the numbers go, even the max drawdown, very, very, very important number. Let's break down the analysis. You'll notice it's still the same though. 1014 didn't move. Okay, it still lost money. I mean, it lost less money, but it still lost money. What did we see that was different in the data? So let's take a look here. So again, the only difference that I am seeing is this number. The difference between the high and the low is significantly higher on that Friday on 1014 than it is for the other Fridays. Okay, the other Fridays, if you average them out, they're pretty much in line with one another. Okay, 0.7, 0.55. Let's go up a little bit higher to 930. 0.9, that was on the higher end, but 0.9, still below 1.4. 0.95, okay? So it's nowhere near 1.8, okay? And that is a difference. Now, let me show you something, and let me discuss something very interesting. So the reason I like to do analysis in Google Sheets and not in Excel, it's just, I mean, you could do some of the stuff or maybe even most of the stuff in Excel as well, but it's just prettier and easier to use in Google Sheets. That's my opinion. But let me go ahead and rearrange this thing, okay? So I want it, let's sort it from Z to A. Okay, so it's going to sort all the columns. So let's go up and see how many times the difference between the high and the low was over 1.4. Okay, so if you include 1.4, and I am, 1.4 here, 20 times. Okay, between here and here is 20 times. So out of, what is that, 206 potential trading days? 207 or 208 potential. Actually, it's 205 because these two columns, or 206 trading days. We have 20 of those days that we may have wanted to potentially avoid trading the indexes. Okay, so ES, NQ, YM, RTY, etc. Because the volatility in that initial hour is much higher than it is on the other days. And in those are the days that I've observed personally, this is my own view and my own opinion, that again, bulls and bears are typically getting slaughtered. Okay, right when you think a trend's about to develop, it pivots and it goes the other way. Those are the type of days that traders want to, in my opinion, avoid. Okay, now imagine if you had avoided, you had this information, so this information is provided to you in the initial hour. We set the trading in the system between 7:30, this is my time, so if you're in the East Coast, it would be 10:31 to 12:29, okay? So we had set up the system after we observed that information, all right? Imagine if you just avoided trading the SPOOs and you traded something else on those days, something that maybe perhaps metals like GC gold or SI silver or HG copper, or if you switched over to the energies, you traded CL crude oil, or you traded natural gas NG, or perhaps one of the agricultural instruments, whatever you decided, but you avoided the indexes. Imagine what the results would have potentially looked like when you look at your actual trading account at the end of the year. Okay, just avoiding those losses, subtracting those big losses from your wins, them not even being on the ledger, okay, imagine those losses not being accounted for because you didn't trade those days, how much potential money you would have saved and maybe even made just because you avoided these horrible days that VR data analyzer found. Okay, so just avoiding these days, okay, imagine, huge difference. Now I should say this just from me talking to a bunch of different traders, right? I do Zoom demonstrations all the time, and I talk to a bunch of traders, all walks of life, everything from actual hedge funds to financial advisors to retail traders to prop traders, all walks of life. Okay, very wealthy people, people that are just looking to supplement their income, all sorts, all walks of life. Here's what I typically hear from retail and prop traders. Okay, how much money did it make today? All right. That, in my opinion, is the wrong way, and I say this, of course, with utmost respect. It is the wrong way of approaching trading. When you look at trading, you have to look at it at a minimum, on a quarterly basis, or more likely throughout the whole year. Remember, how do hedge funds and CPOs and CTA funds, how do they build? They don't build by the day. They don't build their clients by the week. They build them by the quarter. The 2 and 20 that you likely have heard of, that 2% management fee and that 20% performance fee, that gets billed to the client by the funds when? At the end of the quarter, right? And the analysis is done, all of the data, the analysis as to how that fund is performed is done by the quarter and by the year, okay? So this is something that you have to keep in mind, right? So you can't just look at it by the day, in my view. You have to look at it you have to have a longer view when it comes to this. But just avoiding these days would have done, in my opinion, would have made an amazing difference in a potential trader's trading account. Okay, so that's just one of the benefits. The other benefit is to know if you have, for example, similar days that you're finding. And in another demo, if somebody wants a demo, because this video is going to be way too long otherwise, what the range negative and the volatility negative and positive means. But to be able to determine days that are similar, in essence, think about that. If you had similar days that you were able to find, particularly if you set them up to the actual trading day, so Monday being compared with Monday, Tuesday being compared with Tuesday, so you're doing an apple-to-apple comparison as opposed to what a lot of people tend to do, which is they just look at all days being equal, and that is simply not true. Mondays don't trade like Fridays do, and Wednesdays don't trade like Thursdays do, and so on. So you have to do an apple-to-apple comparison when it comes to the data so that you get a more reasonable outcome from the analysis that you run. And so you want to find similar days. Okay, so you have a Monday here and a Monday here. They're both at a 0.25 difference, and you'll notice that the relative range and the relative volatility are both negative. So imagine if you had this data and you had identified a risk and reward that worked for that day, okay? Then it's possible that that risk and reward may work on the other day as well, but the first step that you have to consider is what are your risk parameters? That's the first step, right? We don't think about how much money we can make. We want to see how much money we can potentially lose and still be okay to trade the next day and not have our accounts blow up, okay? And so to determine the risk is you have as a range that's personally developed by the actual trader. So you have to figure out what your risk tolerance is. So if you're trading a 5-tick instrument, you're trading NQ, IM, RTY, etc. It's 5 ticks. So you're going to say, okay, well, I'm willing to risk $250 a trade to as much as $500 a trade, depending on what I think my reward is going to be. So then there's your range. So when you run a back test, you're running the back tests with that information, with that risk parameter, 25 ticks to 50 ticks, and then you put in your rewards. So do you want it to be a 1-to-2 risk ratio? I demonstrated that in this video where I ran 35 ticks risk and 70 ticks profit. Do you want it to be a sort of a different setup where you do a 1-to-10 where it's 25 ticks risk and a 250 ticks, a lofty 250 ticks profit target? In that scenario, what you're saying is I'm willing to have a smaller win rate, but have potentially huge wins when I get them, okay? If I get them. And so it all depends on how you want to set up the trade. I did it 2 different ways and I got 2 sets of results. In essence, though, the one day that stood out was that Friday that the difference was 1.8. Okay, so that 1.8 Friday difference was the actual difference for all of those days. So it was that 10-14, 1.8. Okay, just to refresh. So 10-14, we did that two different ways. All of the days worked with both of the parameters that we ran, the risk to reward ratio. Again, I didn't change anything, all things being equal. We had slippage accounted for. The only thing we haven't accounted for is commissions, but you'll notice that it is not going to make much of a difference because it basically got 29 trades. Let's assume you had 30 trades, multiply that by 5, it's $150. You subtract that from 62.25. It's not making a material difference there, okay? So the point that I'm trying to make is all things being equal, the only day that did, meaning all things being equal is all the parameters being equal, the only thing that made a difference was in fact Friday, the 10-14, where the difference on the VIX between the high and the low was significantly higher than the typical difference you would get between the high and the low. Okay? So, using this data from VR Data Analyzer, one can potentially avoid bad days, and one can actually look at the information and determine based on previous days that worked what their risk to reward tolerance, or risk to reward ratio rather, is going to be. In any case, if anybody wants to see how Price Action Harvester Automated works, please request a demo at pinnaclequant.com. We'll arrange a time, and I'll be happy to share my screen with you so you can see exactly what I'm seeing and ask a bunch of questions, and I'll demonstrate it in full for you. VR Data Analyzer, I think, is an excellent tool. It's going to be very helpful to any trader who's serious about trading. Here is the VR Data Analyzer page. Just go to pinnaclequant.com/data-analyzer, and there it is. You just click on sign up, and it'll walk you through the steps. Hope this video has been helpful. Until we meet or we speak, take care and God bless.